calculator, you can do that. Okay, so you can see that I have the slides up, which are going to be Chapter 4A. We've broken Chapter 4 into two sections, one dealing with the revenue side of things. Chapter 4B will deal with the expenditure side of things. Okay, and I think that's just a better bite-sized pieces for us if we break these two up. Okay, so we're going to cover revenue recognition here, and we are finally going to start to get to some, detailed accounting requirements around government entities here. Okay, so you've seen this slide now a number of times. I don't need to belabor that. You've seen the government-wide statement of net position, right? Where we're focusing our time in this 4A is more on the statement of activities. Now, we've understood the structure, right? We've understood that we have our expenditures and we have our program revenue, etc. And then we have what? We have our general revenue taxes. Okay, we saw there's a structure, but what criteria allows the government to recognize revenue to begin with? I mean, how does it even end up being in our general ledger to be reported on this statement of activities? And of course, if we're at the government-wide level, we're talking what? We're talking full accrual accounting. Okay, so we're going to have to understand revenue recognition for a government under full accrual accounting so that revenue can be reported on the government-wide statement of activities, right? Okay, now I'm not going to go through all of this stuff again, guys. Sometimes I would review this. I don't want to do that, okay? We have our what? Governmental fund balance sheet, but our focus is going to be on the statement of revenues, expenditures, and change in fund balance, in which we have this top section where we're seeing revenues again, right? But what are the criteria that are going to allow us to recognize revenue on the governmental funds financial statements? And again, we're going to be using, not again, now we're going to be using what? Modified accrual accounting, right? Okay, so we're going to have to understand revenue recognition rules both under full accrual and modified accrual accounting so that we end up reporting revenue on these statement of activities at the government-wide level, statement of revenues, expenditures, and change in fund balance at the fund level, right? Okay, and we understand the structure of these statements. And for some reason, I'm starting to get a lack of confidence. I don't know why that this thing is recording, so let me just double check it. Okay, because you don't want me to speak when I'm having doubts, right? Okay, you want me to be fully confident in everything I'm saying. If I'm thinking this thing's not working, that gets a little scary. Okay, all right, so that's what we're doing. Now, when we look, and I'm just going to go through these things, we're going to be looking at first some very basic rules for revenue recognition, okay? And if we're talking about modified accrual basis of accounting, we say that revenue is recognized when it is measurable and available. Measurable and available. Revenue is recognized using modified accrual accounting on our statement of revenues, expenditures, and changes in fund balance when it is measurable and available. Okay, now, measurable means we know the amount. I forwarded through a few slides. This one is listed as slide 319. We're caught up? Okay. Okay, so we've got measurable and available. Measurable means that we know the amount. Available means we have it. So if we collect some revenue, is it measurable? Yeah, we know the amount. Is it available? Yes, it is, because we have it in our hand, don't we? Now you say, okay, well, what happens if we haven't collected it yet? Is it available? And, well, hang on. You're not GASB. GASB has told us that even though we haven't collected it, it could still be considered available if we will collect it within 60 days of the balance sheet. So they give us a window outside of the end of the year, outside of the balance sheet date, to still consider a revenue to be available. Okay, and in this class, we'll always use 60 days. Now, it really depends on the nature. The real rule is it depends on the nature of the revenue. Some can be 30 days, some can be 60, some can be 90. I've seen some that can be 120 days. In this class, just for ease purposes and what is typically the case, we're going to use 60 days as the rule of thumb. Okay, that's what constitutes revenue being available. So we've either collected it or we will pretty soon, right? And we've defined that to be 60 days. Now that's available. What about measurable? What about measurable? I mean, how would a government not know the amount? Can we have a situation like that where the government doesn't know the amount? Huh? Well, what happens? Go ahead.
I was thinking maybe it was like a construction thing, and then you don't know exactly what percent of it is finished or something. So.
Okay, well that's a good percentage of completion type approach where we're estimating the revenue, but governments don't really construct things for others, so that may not be the best. Example, but you're kind of on the right track, okay? In that the government's year ends December 31st. Our taxpayers are going to file their returns, say, April 15th. So at December 31st, do we really know how much revenue we're going to have? We don't know because we don't know who died, who had a baby, who got married, right? We have to wait for the filing. So the reason GASB puts measurable in there is they want governments to estimate what they think their revenue is going to be at the end of the year and take that for the year that it was actually, in the case of income tax, when the underlying transaction took place. So what they would do, and this is why I say, what was your name again, sir? Andy, this is why I say you're on the right track. What they would do is they would look at the return data over several years, look at the refund, and make an adjustment to whatever they've collected, make an adjustment for any refunds amounts they might actually be sending back, right, to those taxpayers. So they're adjusting that estimate of their revenue at the end of the year based on refund data. Okay? We won't get into all that in this class. We just want to understand the phrase measurable and available, and most of our emphasis is going to be on on available, meaning that they either have already collected it or they will within 60 days of the balance sheet. Now that's the rule for modified accrual, isn't it? So that's the rule that we use when we're talking about what set of statements? Governmental fund statements, right? The full accrual statements are going to use a similar criteria, but we're not going to be subject to that 60-day thing. Okay? All right, but let's just look at here now. Don't worry about this dual track nonsense. This is a very simple example in which this government is going to be able to take the revenue when they mail out the tax bills, and then we're going to see the collection of it. And at this point, we're not going to indicate any difference between full accrual and modified accrual. We're going to assume that that these transactions are meeting the criteria for both modified and full accrual. Okay? Just very simple, basic thing. Okay? Now, what happens? We go ahead and we mail out our tax bills. When we mail out our tax bills, we don't debit accounts receivable. You need to know we debit taxes receivable. And since nobody is delinquent at the moment we mail the bills out, we consider that entire amount to be current. Now you say, you mean it's a current asset? No, I mean it's current, meaning they are not delinquent. Nobody's late on their payment. Okay, so we debit taxes receivable current. Now, we go ahead and we credit the allowance for uncollectible taxes for any amount we think we can't collect. Is that what you do in commercial? Is that what you do in commercial? If you think you're not going to collect an amount, you credit the allowance, right? In commercial, though, we debit bad debt expense, don't we, for the amount we're not going to collect, and we report the sales gross. Notice for government, we do what? We reduce the revenue by the amount we think we're not going to collect. We reduce the revenue by the amount we think we're not going to collect. Now, why do we do this? Are taxes an exchange transaction or non-exchange? Good, excellent. Taxes are non-exchange, which means what? You give the government your money and you say, please, police, be there when I need them, right? And so what happens? There is no cause and effect between the generation of the revenue and the uncollectability of such revenue, right? So for that case, there doesn't make sense to record an expense. An expense is what? An expired cost based on what? We want a matching with the revenue, so we take it as an expense. Okay, here, because there was no exchange, we simply reduce the revenue by the amount we're not going to collect. So that's different than commercial, isn't it? No bad debt expense here. You simply reduce the revenue by the amount you think you're not going to collect. Okay? Okay, good. Now notice when we put the amount in the allowance, we also label it as current because right now nothing's delinquent yet, right? We just mailed those tax bills out. Okay, but very important, we reduce the revenue by the amount we think we're not going to collect. But we still set up the allowance, don't we? Just like commercial. Question?
So the allowance for uncollectible current taxes, that's the amount we think we're not going to collect.
That's correct.
And if it's like if it's reported on the credit side, shouldn't the allowance for uncollectible current taxes be like tabbed, like?
Well, look, I'm not going to get into, someday if you want to fix my slides, go ahead. But these are both credits, okay? They're indented to the right. So we credit, let me say it, we debit tax receivable, current for the full amount. We credit what? The allowance for uncollectible taxes, $5,000, and we credit the revenue to make this journal entry balance net of the amount we're not going to collect, right? No bad debt expense like you would in commercial. Right?
Yeah.
Do I need to review commercial allowance accounting? Okay. Okay, good. All right, now you come over and we collect some of the money. This is the beauty of being a government. You send out tax bills, you don't do anything, and people send you money. Isn't it great? So they debit the cash, they credit the taxes receivable current, right? Because people sent some money in. Okay? But there's still $50,000 out there, right? That hasn't been collected. And some people don't pay us. They are late now. So this journal entry is these two journal entries are simply reclassing amounts out of current and putting them into delinquent. So we credit taxes receivable current for the $50,000, debit taxes receivable delinquent, thus taking out of the current and putting it into the delinquent, right? Simple reclass. Since we reclassed the receivable, we're also going to reclass the allowance. So we do what? We debit allowance for uncollectible taxes current to take it out of the current allowance and put it into what? Credit tax receivable delinquent to put it into the delinquent allowance. Simple reclass, right? Okay. Now, since these people are late, we're going to go ahead and hit them with interest and penalties. So we debit interest and penalties, receivable. We figure some people aren't going to pay the interest and penalties, so we set up an allowance for that. We record the interest and penalty revenue net of the amount we're not going to collect, right? Okay? Okay, good. Now, some people are very stubborn. Oh, sorry. This entry is for the general fund. This entry is government-wide. No difference in terms of the logic of debit and credit, just different account names. Different account names that we might use at the fund level versus government-wide. But the logic of the debit and credit is exactly what we saw for the general fund. Okay? Now, some people are very stubborn, and they don't pay us. If somebody doesn't pay you, eventually you will do what? you will write off those receivables. Okay, and so to write off the receivable, what do? You credit the receivable, you debit the allowance, don't you? Okay, so some very basic stuff. You set up the receivable. Just remember that you have to call it current until it's late, then you put it in delinquent in a reclass, right? You do what? You reduce the revenue by the amount that you think you're not going to collect, thus setting up an allowance. And if there is a write-off, you do just like you do in commercial, which is to debit the allowance and credit the receivable, right? Question? Something inside of me is saying they have forgotten their allowance accounting. And this doesn't make any sense because they forgot how to handle the allowance. Is that just the headphones talking to me, or is that the case? Because if you forgot your allowance accounting, this makes no sense. How many people remember your allowance accounting? Let me see. Okay. Because that's all this is. You set up the receivable. The only difference between that and what you would do commercial is when you set up the allowance, you reduce the revenue as opposed to take a bad debt expense, right? Okay. Then what? We have this annoying reclass in and out of current versus delinquent. And then when there's a what? When there's a write-off, just like commercial accounting, debit the allowance, credit the receivable, right? Okay? Okay, good. Now, this is where we're going to get into more interesting stuff. And that we're going to talk about non-exchange revenues first. Non-exchange revenue, for the most part, taxes, aren't they? You pay your tax, you expect the government to be there? Okay, and as we go through our revenue recognition rules, we are going to see that they are applied differently depending on whether we are talking about a derived non-exchange revenue, an imposed non-exchange revenue, a government mandated non-exchange revenue, or a voluntary non-exchange revenue. So we have 4 categories of non-exchange revenue. We have derived, imposed, we have government mandated non-exchange, and what? Voluntary non-exchange. Now these rules, the rules are the same for all 4 categories, but how we actually apply them will differ depending on the category. Okay? So rather than read through these rules here, how do I want to do this? I'm going to just go by category. Okay? So let's just go by category. Okay? So let's start with derived. Okay? What do we mean by derived? They call it a derived non-exchange revenue because the value or the amount of revenue, the amount of tax that we get is determined by some sort of underlying transaction. You can see some of the examples. We have what? Sales tax. What's the underlying transaction that drives sales tax? And here we go. Here comes everybody now trying to hurry up and open up Canvas so they can show me that they're actually paying attention. If you sleep on this stuff, I promise you, you will not understand it, and you'll say, I don't understand anything about governmental accounting because John's not doing a good job teaching the class. And the reality is, you're sitting there looking at, seals playing poker. Okay? Whatever. I don't know. Okay, so pay attention to the material, guys. If you sleep on this stuff, I'm telling you, you're going to sit there and not understand what the hell is going on. Okay? So, the derived tax revenue does what? It derives its value from some sort of underlying transaction. Okay? So, what's the underlying transaction that drives income taxes? Huh? Yeah, the earning of the income, right? The working. Okay? What's the transaction that underlies sales tax? The sale. Okay, what's the transaction that underlies gasoline taxes? The sale of the gasoline, right? Okay, so there's an underlying transaction that drives that revenue, isn't there? Okay, now the rule for derived revenues, therefore, are that you take the revenue in the period in which the underlying transaction occurs. So, I have sales in 2019. But I don't collect those sales taxes until 2020. Is that 2019 revenue or 2020 revenue? Good, it's 2019 because the underlying sale took place what? In 2019. Now we say that revenues are recognized when we meet the well, measurable and available is the modified accrual rule. Okay, measurable means that we have to make adjustments for return data. Available is going to pull in this 60 days. Okay, but when we talk about revenue recognition in government, it's when we have met eligibility and time. We have to meet eligibility and time. Okay, now if we're talking about a sales tax, does the government have to ask itself if it's eligible? Is the government eligible for sales tax? Is a government eligible to collect sales tax?
Yes.
Oh, yeah.
Try them, tell them sometime that they're not. See what happens to you, okay? They are eligible. So government doesn't have to sit there and what? Do any sort of analysis to see if it's eligible. So the only thing we're going to worry about is what? Time. And we say that we will take that revenue when the underlying transaction takes place. So we've met the time requirement, haven't we? For that 2019 revenue that we just gave you the example. Sale took place in 2019. We have to worry about the time requirement. Time requirement is what? Time requirement is that the sale has taken place. So we take that as 2019 revenue, don't we? Okay. Now, what happens? The only thing that changes for modified accrual versus the accrual rule that I just gave you is for modified accrual, we need to see if we will collect it within 60 days. So we have to layer that 60-day availability requirement on top of the time requirement. So we add a little more time. Okay? So what happens? Derived derives its value from an underlying transaction like the actual sale, right? The what? The full accrual rule, just looking at time, is we take the revenue when the underlying transaction has taken place. So we're going to sit there and we're going to do what? If the sale took place in 2019, even though we may not collect that revenue until 2020, we're going to take that revenue in 2019, right? For modified accrual, though, we got to keep our eye on that collection date, right? And if that collection date falls outside of the 60 days, then we have not met time. And a revenue that has met eligibility, and we don't have to worry about eligibility for our derived non-exchange, a revenue that has met eligibility but not time is considered a deferred inflow. Okay, so let's just look at this example here, and I'm just going to go straight to this chart here, in which we have this government that is going to deal with its sales taxes by quarter, the first quarter, second quarter, fourth quarter, July, August, September. So this government has a what? October 1st to September 30th fiscal year, don't they?
Yes.
October 1st to September 30th fiscal year? Hello?
Yes.
Okay. Okay, good. October 1st to September 30th fiscal year. Okay, now what happens? They collect their sales taxes in the quarter following the quarter. So they're going to collect what? Their first quarter taxes in the second quarter, their second quarter tax in the third quarter, the third and the fourth quarter, and the fourth quarter is going to come in the first quarter of the new year, isn't it? So even though they collected some in the first quarter of this year here, that money that they collected would have been what? July, August, September of, say, fiscal 2016. but we're trying to figure out the revenue for fiscal 2017, which begins October 1st, 2017, ends September 30th, 2017, right? Okay, so we have our first quarter sales. We have sales tax of 2,875. They collect that in what? In the second quarter, but the underlying transaction took place in this example in 2018. In 2016, didn't it? In 2016? So this is 2016 money. And since they collected it within 60 days of 2016, it can also be recognized as a revenue for what? For the modified accrual basis of accounting? So we pick that up as an accrual revenue. We pick it up for modified accrual purposes, don't we? Are we still within 60 days of 2016 if we're still in 2016? Are we within 60 days of 2016 if we're still in 2016? Yes, we are, so we can count that as revenue both under modified accrual and full accrual. Okay? Okay, good. Then what happens? We go to the second quarter. We have sales taxes of 1313. We collect that in the third quarter of 2016 in this example. And so we what? The underlying transaction took place still in 2016, so we can take that for what? Accrual purposes. We can take it for modified accrual purposes because we're still within 60 days of 2016, aren't we? We're still in 2016, right? Okay. Then we come over and we have the third quarter sales, 1313 again. We collect that now in the fourth quarter of 2016. The underlying transaction took place in 2016, so we can take it for full accrual, can't we? And for the what? Modified accrual, we can also take it, right? Okay. Okay, good. Now what happens? Now we get into that last quarter. Okay, and we have what? We have, again, sales taxes, and we have what? This 13, 500, and 500. Now notice that for full accrual, we take it all, don't we? And we don't worry about when it was collected, because the underlying transaction took place in 2016, didn't it? But for modified accrual, what do we have to do? We have to look to the collection, and we see that 1113, whatever, 1,113 was collected within the 60 days, because we get that in October, but 200 fell outside of the 60 days. We didn't get that until, what, December, I guess, in this example? Is December 60 days after the fiscal year? It's outside of 60 days, isn't it? Okay, so for that 200, we don't take that as revenue in 2016 because what? We hadn't collected it yet within the 60 days, right? So if you look at the difference between the accrual recognition and the modified accrual, we don't take that 200, excuse me, because what? It got collected outside of the 60 days, didn't it? So we followed the rule of taking the revenue when the underlying transaction took place for full accrual, and then for modified accrual, we kept our eye on it to see when it was collected, right? Now, if you look at this adjusting entry, and we would make an adjusting entry for our 930 statements, notice we set up the taxes receivable and the revenue exactly for the amount that we knew that we had actually earned. And sometimes students will say to me, well, how would you be able to do that of 930 when you really don't know what happened until sometime in October? And the answer is that what? We're probably not going to prepare our statements until, probably issue those maybe until sometime in January into the next year. Okay, so we have some time, don't we? So we would have gotten that information. We would have set up the tax receivable, the revenue, for the what? For the modified accrual, we set up the tax receivable for the amount, and you're saying you're setting it up as a receivable, but you already had collected it by the time you're issuing those statements. But that's okay because at 930 it was a receivable, wasn't it? Okay, we hadn't collected it yet at 9/30. We got that money in October, whatever. So we set it up as a receivable. We take the revenue for the amounts that we know we collected within the 60 days using the 60-day criteria. And as I've said, if you what? If you meet, and we don't have to worry about eligibility for our derived revenue like sales taxes. If you're sitting there and you have met eligibility but not time, then you take what? A deferred inflow, and we haven't met time because we have what? The 60 days? Okay. So this example is a little bit kind of hard to follow, okay? But the most important takeaway here is what? We use eligibility and time. For derived non-exchange, we use what? Only worry about time. We take the revenue when the underlying transaction takes place, right? That's the full accrual rule. And then for modified accrual, we just got to keep our eye on what? The collection, and if it falls outside of 60 days, then we sit there and we treat it as a deferred inflow. That's all that's going on here. Question? Okay, good. Now, impose non-exchange, right? We have 4 categories that we're going to study, derived. Here we go with imposed. Imposed, the government tells you how much money you owe them, how much revenue you owe them. For example, property taxes are a classic example of imposed. They tell you, they impose it on you. They say your house is worth $1.5 million and you're going to send me 1.01% of the value of your house every year. And if you don't send it to me, what are we going to do to you? Take your house. We're going to put a lien on your house. They don't throw you in jail. It's not a criminal offense, but they're going to. Although, no, I just take it back. I mean, if you really got crazy, they could hold you criminally responsible. I think that's more income taxes. I don't know about property tax. They take your house. I think for wealth taxes, they don't throw you in jail.
I thought they garnish your wages first and then they take your house. Or do they just take your house?
Not for property taxes. Property taxes, they're just going to put a lien on the house, and eventually they'll take the house for the property tax if you don't pay them. I don't think they garnish wages because it's sort of seen as a wealth tax, and so the government doesn't want to get into jailing people and, attaching people's wages and stuff for a tax on wealth, whereas a tax on income, for whatever reason, they're more comfortable throwing you in jail and attaching your wages on the income. There's a cause and effect there, right? Okay, so property taxes, are example of imposed. Now, is the government going to have to ask itself if it is eligible for property taxes? They know, huh? Does the government ask itself if it's eligible for property taxes? Go ahead, try it. You'll be losing that house real quick. Tell them, no, you're not eligible to this. They'll say, yes, we are. So they know that they're eligible, so it just becomes a time consideration, right? And so what do we do here with the time consideration? Oops, I'll come back to these questions, With the time considerations, it's what? Time requirements will, here it is right here, this blue. Time requirements will be based on when use may begin. On when use may begin. And then when we're talking about what? Modified accrual criteria, it's still when use may begin, but now we have to see that we've collected it within 60 days of the balance sheet date. So what happens? I mail out my tax bills. And I mail those tax bills out at the end of 2019. I mail them out, say, in October 2019. And those taxes are to be used in 2020. May use begin in 2019? The money is to be used in 2020. I mail the tax bills out in 2019. May use begin in 2020? I mean in 2020, yes. May use begin in 2019? No. So when I mail those tax bills out, I have not met the time requirement, right? So since I haven't met the time requirement, you don't have to worry about eligibility for property taxes. And if I've met what? Eligibility but not time, I have a deferred inflow, don't I? You meet eligibility but not time, you have what? Deferred inflow. If the rule for imposed tax like property taxes use may begin, I mail the bills out in 2019, but I can't use it until what? 2020. Use may not begin, so that is going to be considered a what? A deferred inflow when I mail those bills out. Okay, and then for modified accrual, I have to watch to see if they actually collect it within 60 days. Okay, so let's just look at this example here. City of Hayward has the following information in its accounting records. Property taxes collected in 2014 to cover 2014 activities. So I mailed I've collected 600,000. I mail out tax bills 12/31/2014 to be collected in 1/31/15. Am I within 60 days on this? I'm within 60 days, and so I'm going to include that, right, as the revenue. Okay, by the way, notice it says how much revenue should Hayward report on its statement of revenues, expenditures, and changes in fund balance. Remember I told you you have to know the names of the statements? Guys, I would pay attention like I'm talking how to save your life if you're drowning. Have I told you you need to know the names of the statements? Yes. So you needed to know that this was the name of the governmental fund income statement, didn't you? If you didn't know that this was the name of the governmental fund income statement, you wouldn't know whether you should be using modified accrual rules or full accrual, right? Right? Okay, so this is going to be what? Modified accrual. Have I collected the money within 60 days? Have I collected money within 60 days, that first batch? How about that second tranche? Still within 60 days. How about that last amount? Last amount fell outside the 60 days, so I haven't met the modified accrual time rule. Since I haven't met the modified accrual time rule, I have to do what? I have to go ahead and credit deferred inflow. Right? Okay, good. What would be the journal entry if we're talking about, if I said statement of activities, government-wide? What would be the answer here? Huh? Only receivable and revenue. Good. The entire amount would be $1,500,000, wouldn't it? Because I'm not subject to that collectability issue. Okay. Now, this example you can just watch up on the screen. I have it also in Canvas, but it is not necessary for you to pull it off Canvas here. You can just sort of watch it up here because, to be perfectly honest with you, it's a little bit of overkill just to illustrate the difference between modified accrual and full accrual. Okay, but let's go through it. And you can see here that City of Hayward mails out tax bills for $2 million on November 7th, 2018 to levy taxes for 2019 activities. Use of funds may begin when? In 2019 to finance 2019 activities. So use may begin in 2019, right? Even though they mail out the tax bills in what? 2018. Why do they mail out the tax bills in 2018? Well, they're going to want to see if they can start to get that money in, right? So they mail out in 2018 even though they can't use the money until 2019. Now what happens? When they mail the tax bills out, both at the government-wide level and the general fund level, they're going to go ahead and debit taxes receivable $2 million, credit deferred inflow because they have not met eligibility because 2019 has not begun yet, right? So they haven't met the time requirement. Do they have to worry about eligibility? Sorry guys. They haven't met eligibility because the year hasn't begun yet, right? So even though we don't really have to worry about eligibility for things like property taxes, if the year hasn't begun, then you're not eligible, right? Use may begin. Okay, so use cannot begin, so it's a deferred inflow both under the modified accrual and full accrual rules, right? Okay, now you come over and you take a look at these ledgers over here. I debit tax receivable 2 million. I credit at the government-wide level, I credit deferred inflow for 2 million. At the fund level, I credit deferred inflow for 2 million, don't I? No difference between the two at this point. Then what? Then some crazy people, even though those bills are not due until 2019, pay their taxes in 2018 when they get the bill. So I collect some money in December, say December 1st of 2018. Why would a maniac pay their tax bill for 2019 and 2018? Huh? They get the tax deduction in 2018, don't they? Although the way Trump screwed us up with in California, the deduction is not that great anymore. So probably states like California or counties in California are saying thanks a lot because they're not getting the money as soon because everyone's probably maxed out their itemized deduction just based on the interest on their house, right? Okay, but anyway, never mind. Stop. That's neither here nor there. Some people would do what? Pay their property tax in advance so they get the itemized deduction, right? Okay, so notice when they pay, we debit cash. These people paid $100,000. We debit cash for credit tax receivable, and that's it. There's no recognition of revenue because we're still not in 2019, right? So when we collect that money, and guys, I did not tee up cash here because it's not really relevant to it. So don't say, well, where's the T account for cash? Okay, don't worry about that. I didn't deal with the cash. We go ahead and we credit the tax receivable, which is the same both at the government-wide level and the fund level, right? Okay? Okay, good. Then what? Then clock strikes 12. It's January 1st. Have I met my eligibility requirement? Yes, I have, because now use may begin, right? Now, for the government-wide, it's a piece of cake. I don't have to worry about when I'm going to collect it. Doesn't matter. We are now in the year that use may begin. Isn't that what we said what the full accrual rule was? Use may begin. So we're there. So at the government-wide level, we debit the deferred inflow. We take the revenue. We don't have to worry about when they'll collect that money. Yes, sir. Well, I didn't credit revenue, though. I debited cash. I credited taxes receivable. I didn't take any revenue. Well, my balance sheet has changed and my income statement has changed. I'm recognizing revenue here, sir. I haven't taken any revenue up until now. I had $2 million. Look at that first entry. I had a credit of $2 million to deferred inflow, didn't I? Right? Because I couldn't take the revenue yet because I hadn't met the eligibility requirement. Time use may not begin yet, right? Now I'm in the new year here. What is it? 2019. Now use may begin. I'm eligible. The government-wide level, I take the entire revenue, right? If you talk to him while I'm talking to him, then he has to listen to two people at the same time. Okay, well, in the T accounts then, if you look, all I did over here was I went ahead and I debited the deferred inflow for $2 million government-wide. Now the deferred inflow is 0, isn't it? And I took the revenue and the government-wide revenue, I credited that for $2 million because now I'm taking revenue, right? Right? On my balance sheet, if you're thinking the balance sheet doesn't balance, I took my deferred inflow off of the balance sheet, didn't I? So deferred inflow is now 0. I have cash of 100,000, right? I've got, I've got cash of 100,000. I've got taxes receivable of 1.9 million, and since I would have revenue of 2 million, my fund balance should go up 2 million, shouldn't it? So I'd have cash of 100,000, tax receivable of 1.9, fund balance of 2 million, right? Does the balance sheet balance? Okay, so all that's gone on here is I have recognized the revenue at the government-wide level, guys. I've taken all the revenue, right? That's all that's happened because I've now met the eligibility requirements. I'm now in the year, right? If you're sitting there and feeling sorry for yourself because you don't understand something, you're not doing your job. So is there a question here? Okay. Okay, good. Now, you come over, and for all practical purposes, for modified accrual, since we don't know if we're going to collect the money within the 60 days, we won't take any revenue until we actually collect. We're going to wait for the collection to take revenue under modified accrual, since we have to see if any falls outside of the 60 days here. Okay? So when we look at this, have we collected any money? We collected what? We know we collected 100,000, didn't we? So for modified accrual in the general fund, we will take what? 100,000 of revenue and debit the deferred inflow for 100,000 because we've collected that much. So at the governmental fund level now, notice we have a different revenue amount. We have 100,000 here, and we have debited deferred inflow for 100,000. So 1.9 is still showing as the deferred inflow. Maybe that was where you got confused on the T accounts. One is for the government-wide, one is for the fund level. Okay. Modified accrual versus full accrual accounting. Remember we said that a lot of this class is going to be about understanding those differences, right? Okay. Okay, good. Now what happens? Now we go ahead and say in April of 2019, we're now well into 2019, we collect another million. When we collect that million, we, of course, debit tax, we credit taxes receivable. That's a piece of cake. Debit cash, credit taxes receivable. Right? So when we credit the taxes receivable for $1 million, we still got 900,000 left to go. That's the same both government-wide and fund level. But now what? We don't have to do anything at the government-wide level because we've already taken the revenue because we started 2019 now in this example, right? But at the fund level, because we've collected some more, take some out of deferred inflow and put it into revenue, right? Okay, and so when I do that, now I have the debit to deferred inflow for $1 million. There's still 900,000 out there that I haven't collected yet that I'm keeping in deferred inflow, and I can go ahead and take another $1 million of revenue here, right? Okay, then what? Then I go a little deeper into the year, and now it's September, and I collect 800,000. Again, debit the cash, credit the taxes receivable for the 800,000. When I credit the tax receivable for 800,000, there's still 100,000 left to go, right? Okay, and I can go ahead now and recognize some more revenue at the fund level by debiting the deferred inflow for this 800,000 and crediting the revenue for 800,000. When I debit the deferred inflow now, I'm sitting there and I still have 100,000 left to go in my deferred inflow, and my revenue is now 1.9 million. Then I go and I collect some more, and I'm now in January. Now when I collect some more in January, am I within 60 days of January 2020? Am I within 60 days of 2019? It's the easiest question I'm going to ask you all night. On January 7th, 2020, am I still within 60 days of 2019? Yes. Yes, I am. So can I take that revenue for modified accrual purposes? Yes, I can. So I go ahead, again, I debit cash, I credit the taxes receivable. There's still 25,000 that at that point I wouldn't have not collected yet, right? Okay, but I go ahead and I can take that revenue At the fund level, I debit deferred inflow, credit revenue. You say, wait a minute, but you're in 2020 now. But I'm still within 60 days of 2019. So I've met my modified accrual rule here, right, for 2019 revenue. So I go ahead and I debit the deferred inflow. Deferred inflow is still going to show 25,000. Where's my deferred inflow? Right there, I debit the deferred inflow. Deferred inflow still shows what? 25,000. And I'm taking the revenue now, 75,000 in my 2019 revenue ledger, right?
So that 60-day only works for going to the next year. Doesn't mean 60 days for the whole transaction period.
Well, if I'm still in 2018 in this example, then I'm still in 2018. Yeah, you only start counting the 60 days after the year is ended, right?
Oh, I thought it was September and January 7th, right? Did it jump?
What?
I thought it was September. Oh, no, I guess I'm not seeing the dates.
Okay. We are now in January of 2020.
Correct.
Okay, the year ends December 31st.
Correct.
Okay? January 30th would constitute 30 days after year end. February 28th would constitute 58 days.
So you're talking about strictly just for the year, not talking about like every transaction, because the one prior to that once was in January, right? Or September. So that's past.
Okay, in this example, the year begins January 1st, 2018.
Okay.
You've seen a calendar before, right?
Yeah.
Okay, the year starts January 1st, 2018, right? Okay, is January in 2018? Is January 2018 in 2018?
Yes.
Is February 2018 in 2018?
Yes.
Is March 2018 in 2018?
Yes.
Is April 2018 in 2018? Is May 2018 in 2018?
Yes.
Is June 2018 in 2018?
But that still doesn't answer my question.
It'll answer your question if you choose to understand.
Okay.
Is June 2018 in 2018? Is July 2018 in 2018?
Yes.
Is August 2018 in 2018?
Yes.
Is September 2018 in 2018?
Yes.
Is October 2018 in 2018?
Yes.
Is November 2018 in 2018?
Yes.
Is December 2018 in 2018?
Yes.
Is January 2019 in 2018?
No.
Is it,
Oh.
well, for revenue recognition purposes, here it is, because it's within 60 days of 2018, isn't it?
Okay.
Is February 28th in 2018?
Yes.
No, for revenue recognition rules it is, but it's within 60, it's in 2019. Come on, guys, let's not, crash the moon into the sun over here, okay? February 2019 is in 2019, but it's within 60 days of 2018, isn't it? So we took the revenue for that, right? Well, in the January one. We only have to worry if it's going to follow what? Outside of the 60 days. Okay, so far, every collection I've shown you on here has happened either in 2018 or within 60 days of 2018, right?
That's what I was asking. So the 60 days is only for the year, not like per transaction. Because I thought it was per transaction.
I don't know what you're saying to me.
Like for example, like from the first journal entry to the last, I thought it has to be within 60 days. If it hasn't, it will go into deferred. But I didn't know you meant just 60 days after the first 2 months.
Okay. The rule is for full accrual accounting for property taxes for an imposed non-exchange revenue, you take the revenue in which you've met when use may begin.
Okay.
We didn't take the revenue when we first mailed the tax bills out in, I guess it was 20.
I got it now, but yeah, I got it.
We didn't take because.
I'm not sure that you understand my question, but I got it.
Well, I'm not seeing what your question. It seems like nonsense to me. That's why I'm not getting it. That's why I'm sticking with it, because the way you're asking the question indicates a lack of understanding to me. Okay, so if I'm sitting here and in 2018, it's not 2019 yet, right? So that's why I put the whole amount in deferred inflow under both rules, right? As soon as I entered into 2019 for government-wide under full accrual, I took all the revenue, right? No more deferred inflow. For modified accrual now, I'm just, as a practical matter, not going to take any revenue until I actually collect, because I want to see if any amounts fall outside of the 60 days, right? And so far, every single transaction that I've shown you up here has fallen either in 2019 or within 60 days of 2019, including this January one that we just looked at. Okay, but then I get down here and I have this amount that gets collected in March 2020. Is March 2020, March 20th, 2020, within 60 days of 2019? It is not. So what do? Debit cash, credit the tax receivable. Now, and in this example, I'm assuming they haven't mailed out any more tax bills, which that probably wouldn't be the case. But at least we've collected now all of the 2019 receivables, haven't we? Okay. And notice now we don't believe that any more is deferred inflow. It can now all be revenue because we've collected it. But I have to open up my 2020 revenue ledger, don't I? That's not 2019 revenue. That is 2020 revenue because it fell outside of the 60 days, didn't it? You report revenue by year, don't you? So you hit close your 2019 revenue, you open up your 2020 revenue ledger, right? And I record that in 2020 revenue. So if you compare the two, okay, and this is what I'm saying, guys, it's an overly puffed up example to illustrate the very simple point that if you look at the revenue, the difference between the general fund and the government-wide was what? Was the amount that fell outside the 60 days. That $25,000 that fell outside the 60 days didn't matter for what? Full accrual, because I took it all as soon as use may begin. But because I had to keep my eye on that 60 days, the what? For modified accrual, that $25,000 that fell outside of the 60 days was not a 2019 revenue, it was a 2020 revenue, right? So that example goes on a bit for the very simple takeaway that what? The rules are pretty much the same. For an imposed non-exchange, it's when use may begin is the rule. That's the rule for both modified accrual and full accrual. But for modified accrual, we got to keep our eye on that 60 days, don't we? That's all that happened here. Question? Okay. Let's take a look at this question. And that example is up on Canvas. Again, I don't think that you need to sit there and pore over that example. If you're understanding that bottom line conclusion, you might save yourself some brain damage by not looking at that. Just remembering that what? The difference is the 60 days. Okay, so let's look at this question. Assets such as property taxes associated with unavailable revenue, such as property taxes collected more than 60 days after year end, should be recorded by crediting what? Deferred inflow is what we had there. If it was going to fall outside the 60 days. Okay, fines are also an imposed non-exchange. Okay, but we have to really just think about eligibility, okay? And so the eligibility issue is, does the government have a legally enforceable claim? Well, we don't know. The government can't go around telling you, hey, I'm fining you, and you have no due process. That the government can't do. They can tell you you've got to pay on the value of your house, you got to pay your income taxes, but if they come up and fine you and say, hey, you parked your car illegally, you have due process. You can show up to court. Have you ever done that?
Thankfully, no.
You've never parked your car improperly? Got a ticket for it? Okay. Well, I'll tell you a story. I got a speeding ticket one time. And so the talk around the campfire was that all you have to do when you get a speeding ticket is show up to court. The cop won't show up, and you automatically win the case. because they're not presenting any evidence that you violated the law, right? So I'm like, oh, okay, well, I'm going to set a court date and I'm going to show up. So the cop, of course, shows up, right? So now I'm like, okay, so it's my time to testify. The cop stands up and says, well, I ticketed Mr. Lord for doing, I clocked him at doing 75, and I cited him for doing 65 in a 55-mile-an-hour zone. That's when the speed limit was 55 or something. So I don't have anything to say. I was just hoping the guy wasn't going to show up, but I didn't want to say that. So now it's my turn. So I say to the cop, why did you ticket me for 65 if I was doing 75? And the judge looks at me like, okay, where's this kid going with this, because he certainly said it in a way as though he knew what he was doing. The cop says, because I was trying to give you a break, and I said, no further questions, Your Honor. Okay, bam, 65. Okay, so you have that process, right? So the government has to see if it has a legally enforceable claim. Let me give you a more an example from an experience I had at the GAO. What U.S. Forest Service does is what farmers and stuff do is they do like a controlled burn. So if they have like a lot of weeds and stuff and they want to get rid of, they want to clear a certain amount of shrubbery, they'll burn it. They'll just burn that down. They call that a controlled burn. Well, sometimes a controlled burn is not controlled. And it jumps over the lines and it sets like a whole parcel of the forest on fire, right? And so what the Forest Service was doing was they were going and billing those farmers, whatever, for the lost inventory, for the cost of putting out the fire, all that sort of stuff, right? Now, what was happening is some of those individuals were saying, it wasn't us. We didn't set the fire. But what Forest Service was doing was taking the receivable and the revenue because they had billed those individuals. And we backed up and said, you can't do that. You don't have a legally enforceable claim, so you can't take the revenue until you have what? Legally enforceable claim. And we made them back that out of revenue. We made them make an adjustment for that. Okay? So, you have to have a legally enforceable claim, right? Okay, now, when you look at this example with the parking ticket, okay, parking violation upon discovery is $100. 1 hour failure to move is another $50. Now, the violator pays the $100, but disputes the $50. And it isn't until what? It isn't until, so on December 24th, they pay the $100. The $100 can be revenue, right? The amount that is still in dispute, they haven't proven that they have a legal enforceable claim, so that is not going to be taken as revenue. So in this example, the revenue would only be what? The $100 because they don't have a legally enforceable claim for the rest of it, right? Now you're sitting there and saying, well, how do we know they had a legally enforceable claim for the $100? How do they know they had a legally enforceable claim for the $100? When was the last time you gave up $100 and you didn't think you owed it? When was the last time you paid $100 and you didn't think you owed it? So we see what? The payment of the $100 as an admission of guilt. If you're paying the $100, you must think you're guilty, right? Okay, so the payment is what triggered the revenue recognition there. The $50, since they hadn't paid it yet and they have a due process, we're not going to take that until they go through that due process. Okay? Non-exchange fees, for all intents and purposes, take it as revenue when it's paid. When you pay for your driver's license, can you drive the car immediately? Yeah. You're eligible to drive at that point when you pay your license, right? So we would take that as soon as that is collected. Some licenses, though, you pay the fee now, and it doesn't allow you to do whatever that activity is until a later time. So in that case, the government has to wait until you are actually allowed to engage in that activity for which you paid the license for. If that's the case, you have to wait until what? And we're kind of back to when the use may begin rule. Okay? So you tell when the activity may begin. So let's just take a look at this example. City of Hayward sends out billings for business licenses in November 2014 for $870,000 that allow companies to do business in Hayward in 2015. So the activity that license is allowing can't begin until what? The next year, right? So if that's the case, then what? How much revenue should Hayward report in 2014? Answer is what? 0. They'll go ahead and debit the license fee receivable. Even if they collect, I guess that's what the question said, they collect the entire amount still, it's what? Simply going to be a debit to cash and credit to license fee receivable. Revenue won't happen until what? Till the clock strikes 2015. Then we'll be able to debit the deferred inflow and credit the revenue, right? But in 2014, what? We have a deferred inflow, don't we? Okay. Okay, good. Let's look at this question. And this is one that I stole from the CPA stuff, which I'm still going to get for us. I just got to sign off on that now. Becker has sent that to me and agreed for me to do that. So as soon as I sign off on the paperwork, we'll be getting you the financial section of the CPA review course. Okay, but Davis County has a December 31st year end, typically bills and collects occupational license for regulated business in jurisdictions the year before the license is valid. In October of year 1, Davis County billed for year 2 occupational licenses in the amount of $250,000. What should they take for year 1? Revenue is 0. Deferred inflow is that whole $250,000, right? And it's not until year 2 that we'll take that as a revenue. Because the activity, what, doesn't take place until year 2, right?
Yeah.
Okay. Okay, good. So that gets us through what? That gets us through our derived and our imposed, essentially, right? Okay, derived what? Derived was when the underlying transaction took place. That was the rule for both modified accrual and full accrual, but for modified accrual, always got to worry about 60 days, right? For the imposed, it was pretty much when, for things like property taxes, is when use may begin. Same for modified accrual and full accrual, but we had to keep our eye on the 60 days for the modified accrual, right? For imposed non-exchange like fines and penalties, it's when the government has a what? Legally enforceable claim. Okay, for things like licenses, it's when can the licensee engage in that activity, right? Okay? Okay, good. Now you come over and let's take a look at what happens with our government mandated involuntary non-exchange, our last category of non-exchange. Okay? Now, when we look, and you can see these 1, 2, 3, 4, required characteristics of the recipient. What happens here? Required characteristics of the recipient, am I a county? Are they giving this money to counties? Am I a county? So that's almost a who cares, okay, criteria there. Time requirements, period in which grant must be used. So now we're going to be dealing with a situation in which maybe the state is going to give us some money and tell us that we must use that money in the state's fiscal year. So what happens? Let's say we have a county, and the county's fiscal year begins January 1st. I guess that would be their calendar year then. The year begins January 1, ends what? December 31st. We all know that, right? Okay. Now what happens? The state's fiscal year, as many states do, has a fiscal year that begins July 1. Let's just put some years on this. 2019. County's fiscal year begins January 1st, 2019, and ends December 31st, 2019. Now, for fiscal year purposes, this would be state year 2020. When does the state fiscal year end? June 30th, 2020, right? And that would be fiscal 2020. Now, the state tells the county, you must use that money in the state's fiscal year. You must use that money in the state's fiscal year. So let's say they give them $1 million. Now, they're going to use some of that money, probably what? Probably in these counties' fiscal 2019, right? Because they got the money on July 1st, 2019, right? But some of it they might use in what? In county 2020. So is this 2019 money or is this 2020 money? Someone says both. Both, huh? Huh? Is it 2019 money or 2020 money for the county? You want to say 2019? You want to say both? Because they're going to use the money, some of it in 2019, some in 2020, aren't they? So we have a little bit of an accounting dilemma. Don't worry, GASB has told us that what? That is all 2019 money. It is all 2019 money because what? Period in which grant must be used. We have entered the period, or we are in the period when the grant must be used. So you take that all as 2019 money. I know your accountant heart wants to allocate and say, well, wait a minute, 6 months fell in one year, 6 months fell in the other. That's not how it works. As soon as you enter the period in which use must begin, you take all that revenue. And we are in that period, aren't we? When we get that money? Now, this is an example of a government mandated non-exchange, and that what? The state was probably telling the county to do some sort of environmental cleanup and funds that, and they give them the money, and they say you're supposed to use it in the state's fiscal year. And since we're in the state's fiscal year now at this point, then we can use that, we can take that revenue, can't we? Even though we may not use that money until what? Another year, right? Yeah. Okay. Now, you have this next potential here, number 3, in which we say, well, what if it's a reimbursement type grant? So now the state acts like the Godfather. You ever seen the movie The Godfather? Where the gangsters, can you sing gangster movies where the gangsters come down and say, don't worry, any expenses you have we'll cover for you as long as your interests don't conflict with ours, right? Of course, whenever they say that in a gangster movie, you know there's going to be conflicting of interest, and that's when people are going to start getting killed, okay? But in this situation with governments, there's no conflicts of interest. They're simply going to do what? They're simply going to pay them, reimburse them for any cost they incur, right? So when can that lower level of government take that revenue? Answer is what? When they incur the cost. Right? So they spend some money on environmental cleanup. They spend $300,000. They're going to debit expenditure. Credit what? Credit cash for $300,000. They're going to do what? Debit grant receivable $300,000. Credit revenue $300,000 because now they're expecting that reimbursement, aren't they? So if it's a reimbursement style government mandated situation, then you have to wait till you've actually spent the money because they told you we'll reimburse you for any money you spent, so you really haven't met the requirements until you've done what? Until you spent the money. Okay? Okay, good. Now, if we are talking about contingencies, and contingency only comes up in the voluntary non-exchange. With voluntary non-exchange, now what's happened? Now this lower level of government has applied for some money, haven't they? They said, look at us. We meet the eligibility requirements. Please give us some money. If that's the case, then we have to look to see, and finally eligibility, in my opinion, is even on the radar for us because we didn't care when it came to derived. We didn't care when it came to impose. Government mandated is what? We just took it as revenue as long as we were in the period in which use must begin, and for the contingency, I mean, I guess contingency is kind of an eligibility that you have to have spent the money. But here, this is a true pure eligibility that you have to have met whatever they said you have to do to be eligible for that money to take that. Okay? Now, if you've met eligibility, but then we layer on top of that a time requirement, if you met eligibility but not time, then you would be what? A deferred inflow on that money, right? Okay, so finally, we bring all the rules together when it comes to a voluntary non-exchange. Now we're going to get a chance to see what? Now we're going to get a chance to see eligibility. We're going to get a chance to see time here, right? So even though we say you take revenue when you've met eligibility and time, if you've met eligibility but not time, it's a deferred inflow, all of that, finally it comes into the voluntary non-exchange that you're able to go through that whole cycle. Okay, so let's just go ahead and let's look at this example. A little bit hard to see on the screen here, but Progressive Township College received a $900,000 multi-year research grant available for use on a pro rata basis over the next 3 years, subject to other enrollment-based eligibility requirements. At the end of year 1 of the grant, the college had reached enrollment levels that satisfied grant eligibility equal to $500,000. So they're eligible for what? 500 of the 900,000, okay? And they tell us that what? It has to be used over a 3-year period. So we've got enrollment eligibility, we've got 3-year period time requirement, don't we? Okay? So if you look at the solution here, they received 900,000. We know that we have met eligibility for 500,000 worth, right? But we go ahead and we divide the 900,000 by 3. We've met eligibility and time for 300,000 of that, haven't we? So if you look at the solution here, notice the revenue is 300,000. But we have met eligibility for what? Only 500,000. We've taken revenue for what? 3, so the difference, the 200,000 is deferred inflow because we've met eligibility but not time for that part, right? And then the remaining what? The remaining 400,000 here, that's if you take the what? The 900,000 minus the 5, the remaining 400,000 for which we haven't met eligibility nor time is a liability. We call that revenue collected in advance. Don't call it deferred revenue. It's revenue collected in advance. You only use the D word for what? For deferred inflows, right? Okay. So I just want to show you, after we've gone through that, this graphic here, this wonderful graphic that I showed you the other day, which is what? You cannot be a revenue if you haven't met eligibility, right? You haven't met eligibility, you're not a revenue. So if you haven't met eligibility, you are a liability, aren't you? If you meet eligibility but not time, which is what we had for that 500,000, you are for the 400,000, excuse me, because we had met eligibility for 500,000. For the 400,000, we had met eligibility but not time, so we were a deferred inflow. For the 300,000, we had met both eligibility and time, hadn't we? 900,000 has to be used over a 3-year period. That's 300,000, and we had met eligibility for 500,000, hadn't we? So that 300,000 had met both eligibility and time, right? Okay? Okay, good. Let's go forward, and let's look at this slide. Okay, this slide summarizes really everything we talked about in those examples and has the key takeaway points. So I guess I should put those creepy little stars on this. Okay, this is a good slide for chapter 4 to sleep with under your pillow. Okay, let's take a look at it. We have all the categories, don't we, of non-exchange revenue: derived, imposed, government mandated, voluntary, right? Let's see what we say. We give you examples. Derived non-exchange, sales tax, income tax, right? They derive their value from the underlying transaction. We only worry about time requirement for that one, right? And the rule was when the underlying transaction took place. That's the full accrual rule right there. Okay. Notice that what? All revenue types are subject to the 60 days. So you always got to keep your eye on that 60 day. Will they collect within 60 days? Imposed was what? Imposed property taxes, fines, and penalties when use may first begin for things like property taxes, when the government has a legally enforceable claim for the fines and penalties. We only worry about time there. Again, you got to watch that collectability of the 60 days. That's probably most important for property taxes because what? Pretty much the fees for the speeding tickets and stuff, they're going to pretty much be paying you pretty quickly, aren't they? So really, that collectability issue only comes into play more in the property taxes. And then we had that big example, and all at the end of the day was 60 days was the difference. Okay, government mandated, higher level of government directs lower level activities. The state tells the county to do some cleanup. You look at time and eligibility, although frankly, it's a little silly to really mention eligibility because what happens? The state tells the county to clean something up. What's the county going to say? Here, no, we're not cleaning it up. The state will say, well, then we'll see you in court, and eventually they will clean it up, right? So eligibility is a little silly here. Okay, so it's really more what? Time and what? When use must begin? When use first begins? Was the rule there? Okay. And then if we're talking about government voluntary non-exchange, like a competitive grant, yes, time and eligibility finally are relevant, aren't they? Okay, I mean, I guess for the government mandated, maybe eligibility is interesting when we're talking about contingencies. You've got to spend the money first. Other than that, okay, eligibility is kind of nonsense. But when you finally get to what? Voluntary non-exchange, now eligibility matters because you got to have met whatever the requirements are, right? To even take it out of a liability and into a deferred inflow, right? And then to take it to revenue, you have to meet whatever the time requirements are. And that was that last example we had. Okay? Okay, good. Now you come over and exchange revenue when the government provides a service. If you're paying the government to provide a service to you, then the government can take that revenue when they provide that service. So if you're sitting there and you're paying for a permit so that you can protest and they're going to give you police service, they take the revenue when they give you the police protection, whatever, right? Okay? Okay, good. Let's take a look at this question. Let's see. See if we can figure out if this money falls in year 1, year 2. Okay, and so we have the city of Hilltop has the following transaction using modified accrual basis of accounting. So they're holding us to modified accrual here, aren't they? Okay. Which year should the revenues be recognized? Okay. Sales of $200,000 is collected in January year 2 related to year 1 sales. Has the underlying transaction taken place? Huh? Year 1 sale. Are we within 60 days of year 1? Yes, we are. So that's what? Year 1 money? Okay, good. Sales tax of $100,000 is collected within 60 days of December 31st, year 1, related to year 2 sales. That's year 2 because the underlying transaction took place in year 2. Maybe you had those sales in January of year 2 and you collected the money in year 2, right? So this was kind of tricking you to think, oh no, it's within 60 days, so it's year 1 money. No, when did the underlying transaction take place, right? Okay, good. Number 3, December year 1 gas taxes of $250,000 collected by gas stations are remitted to the state 15 days after month end and remitted by the state to the city 45 days. What's 15 plus 45? 60. So will Hilltop City get this money within 60 days?
Yes.
When did the underlying transaction take place? Year 1. So that is year 1 money. Okay. Number 4, property taxes of $2 million for year 2 were levied in November year 1 and fully collected by February year 3. I guess to make this interesting, I should put year 3 over here, right? Huh? This is year 2 money because what? Underlying transaction, property tax is not underlying transaction, this is imposed, but they're for year 2, right? property tax for year 2, even though they levied the thing in year 1, and then they collected within 60 days of year 2, didn't they? So that's year 2 money. Occupational licenses for year 2 of 75,000, budget for the operation of the code enforcement department for the year 2, and authorizing the holder to do business in the city in year 2. We're billed in year 1, and we're not collected until February of year 2. Well, did they say year 2 enough in that one for us to know that's year 2? Because that's when they let you do the business, and they got it in year 2, didn't they? Parking citations 10,000 issued on New Year's Eve year 1 were fully collected by February year 2. I don't like this city ordinance allows for the assessment of penalties on the date of the citation. What it should say is the government had a legally enforceable claim in year 1 if they want the answer to be what? Year 1, which is where they were trying to set us up. I mean, city policy doesn't dictate what we're supposed to do under the accounting rules. Okay, and I would look at this question and I would sit here and say, well, wait a minute. How would the government know that it has a legally enforceable claim if it didn't cite them until December 31st? I mean, was it standing out there saying, hey, you drunk dude that's getting back in your car December 31st, you owe us some money for that parking violation? Pay up? I mean, they're not going to know until what? Until the next year, aren't they? Most likely as to whether they have a legally enforceable claim when the person pays them in year 2. So I'm thinking that should have maybe been year 2 money. That's not the best question. But the textbook answer is year 1. Okay? Where are you going? Hang on a minute. Because I want to go ahead and I am going to have you do most of the quiz on your own, then we're going to come back and go through it together when we come back. But I just want to go through a few of these questions with you to get you kick-started on them. And I think once we kind of do that, you're going to start to see that this stuff probably sounds a lot more complicated than it is. Okay, so let's look at a couple of things. And I'm going to go ahead and skip past these word questions, and I want to go to a numbered question. Question with numbers in it. Okay, a city that has a December 31st fiscal year end has adopted a policy of recognizing the maximum amount of property tax revenue allowable under GAAP. Property taxes of $720,000, of which 10% are estimated to be uncollectible, are levied in 2013 to finance the activities of fiscal year 2014. During 2014, and they start giving me cash collections, blah, blah, and then they tell me, related to the 2013 levy, what should I take on my government-wide statements? Now, do I care when they collected the money in the government-wide statements? Does not matter in the government-wide when they collected, and so I'm just trying to figure out what should be my revenue for 2014, right? And they told me that this money is to be used in 2014, right? Okay, so use may begin in 2014. But we have to remember that we reduce our revenue by the amount we think we're not going to collect, right? That was the same both for government-wide and the fund financial statements in terms of the allowance and all that. So what are we going to do? We're going to take the 720,000 times 0.9, right, because 10% is not collectible, and that's going to give us the 648, right? So in 2013, we'll debit tax receivable. Well, I'm not going to do the journal entry for this one because it gets a little more complicated when you got an allowance in there. But we have to remember to do what? We have to remember that we reduce the revenue by the amount we think we're not going to collect. Okay? All right, now here I give you the same rules, the same fact pattern, but now we're dealing with our governmental fund financial statements. So does it matter when we collect? So now we start paying attention to all this collection information, don't we? So they tell us that cash collections related to that 2013 levy that's for the 2014. Occurred in 2014, 600,000. That's 2014 money that they collected in 2014, right? Okay. Then they collect some amounts in 2015, which is this January 30,000. Is January within 60 days of December 31st? Yes, it is. So I'm going to pick that up. How about this March? Okay, they should probably say when in March, because we're saying 60 days, and if it was March 1st, okay, but I think they're assuming it was a little later in March. Okay, so are we going to include that? Are we including this? We're assuming it wasn't March 1st or March 2nd, whatever, right? Okay, so that means that the answer here is 630. Okay? Okay, so look at the rest of these. We will do these together when we reconvene on next Wednesday. Okay, but you can see, guys, that we're getting to the point now where you're really going to have to start paying attention to this stuff in between class times, right? So just don't let all this go out to one ear and in the other and not look at it before we reconvene. All right, I'll see you next week.